welcome for the introduction. Thank you very much, Young, for setting this up. And I'll privately thank Stephen for doing the same. Thanks everyone for coming. I really look forward to your comments on our paper. The title describes the paper. It is on attrition bias and the effect of attrition bias on inferences regarding earnings properties, or at least the earnings properties we choose to look at. We look particularly at Compustat data, although it's hard to imagine that this kind of bias wouldn't exist in pretty much any data set. I want to mention my co-authors. One of them is on the call, and he also presented a paper last week, Martin Capons. Originally, I was writing a paper with Peter Kelly and Andy, who were colleagues at Notre Dame at the time. Peter still is. Martin was a research master's student at Tilburg, and he independently wrote a master's dissertation that was very similar to ours. The situation was such that it would be unlikely that he would publish his paper without ours. And he had such a good idea in his paper that it would be silly for us to publish our paper without him. So Martin joined us as a co-author and has very much driven the project since that time. Martin is in the audience. I'm not going to put him on the spot, but he's more than capable of answering whatever question you ask. So what's the paper about? First of all, we observe, and this is just the data, that 8.5% of firms on the Compustat annual data file that had earnings last year don't have earnings this year. In other words, 8.5% of the observations disappear, which initially and still does struck us as this is a lot. So there's likely to have an effect on our results. The effect is also likely to be a problem because the disappearance is not random. I'll talk about what the characteristics of the firms that do disappear shortly, but they're certainly not a random cross-section of firms. So since they're not random, this leads to what other literatures have called attrition bias. So this is bias and we're going to look at bias in the estimates of earnings properties that require 2 consecutive years, T-1 and T, earnings. In particular, we're going to look at earnings persistence, mean reversion, and the accuracy of forecast of earnings that are based on earnings of the prior year. In particular, the problem here is that 8.5% of the forecasted earnings are not available to calculate a measurement error. And so these observations are just ignored in the calculation of the mean, median, mean squared error, whatever. And that does affect the results, as I'll indicate or demonstrate. So what is attrition? Attrition occurs when observations disappear during the study. And some obvious examples are in medical experiments, patients die. The patients that die may be non-random. In other words, they may have a certain characteristic, and to assume that the drug effect on those patients that died would be the same as the effect on those that lived would be a mistake, very likely. So the point here is that the people who die in that experiment are different to those people that live, potentially. Similarly, the earnings that disappear of firms that disappear are likely to be different from those that do not disappear. So this non-random disappearance leads to attrition bias. And the overarching concern then is that we may in fact falsely reject a null hypothesis that's actually true. In other words, a type 1 error. So this creates a problem, and one of the things I think we do make a contribution on is we suggest 3 methods for imputing the disappeared earnings observations. In other words, replacing them with a possible or likely outcome or a proxy for the outcome. And we find that conclusions about the properties of earnings change when we use the imputed earnings in order to reduce or study the effects of attrition bias. So the paper in a nutshell, most of our analysis, not all, but most of our analysis is based on this regression where earnings of the next period are regressed on earnings of the prior period with a dummy variable that picks up whether earnings were negative last period or positive at last period. So this variable is 1 if earnings were negative, positive otherwise. And we have an intercept and an interaction dummy. Now, again, in a nutshell, the prior literature shows that, or concludes that positive earnings are highly persistent. The coefficient on negative earnings is, of course, the sum of the coefficient on positive earnings and the coefficient on negative earnings. And this coefficient is less than 1, suggesting mean reversion. What the prior literature has recognized is that bad performers do disappear from the data, and they all suggest that there may be bias, but no one, as far as we know, studies that bias. So our findings are positive earnings are less persistent in recent years. The conclusion with respect to positive earnings does not differ when we add the imputed earnings to the data set. On the negative side, we find mean reversion if we ignore attrition, but we don't find mean reversion if we replace the observations that disappear. And what's interesting, and this is just the data, what we find is that negative earnings, in fact, tend to be more persistent than positive earnings. So then the why should we care? Well, measures of earnings quality, persistence is suggested as one of the key measures of earnings quality, show the opposite pattern to what has been previously documented. And second, we demonstrate false inferences from regression-based forecasting models, which have become increasingly popular in the literature, as we're all aware. I'm coming to the end of the summary slide, so
okay.
please.
Steve, please. Steve, you have a question?
Oh, I get to ask my question now. I thought you wanted to get to the end of the summary slides first, Peter.
I'm there.
You said that the data, these firms disappear in Compustat, which raises the question, I guess, whether they have actually disappeared or whether Compustat is simply failing to collect data which is available out there. Can you, do you know that whether it's the former or the latter explanation?
I think it's both. In fact, I don't think we could separate that. So Compustat collects the available data from firms that file. They may stop filing for whatever reason, and Compustat will stop collecting data. Now, there's a related question, which is firms could disappear in T, but come back in T+1. Now, in our analysis here, we include those observations because they will have in fact disappeared in T. But if we remove those observations, there's not many, 191, then there's no effect on the results. I'm not sure that answered your question, Steve. Good to see you, by the way.
Oh, good to see you too. So the question, I guess, is whether the data are, let's say, with the SEC. So if they're in Edgar, then it's Compustat, which is the source of the error. And if they're not in Edgar, then what's happened to those companies? Have they gone out of business? Have they gone private? Has something else happened? It sounds like there's just a handful of them, but just to sort of say they've disappeared raises some questions that it doesn't sound like you can easily answer at this point. I guess that's my observation.
No, and that's fair enough, but I'm not sure we need to answer them, because what we're talking about is observations that have been made, conclusions that have been made based on the Compustat data. So this is a specific statement about a bunch of research, in fact, most research, which has been done on the data that we analyze.
But your adding new data, right?
Yeah.
By imputing something to the missing values that are in Compustat.
Yes.
And I guess it's not clear to me yet that what you're adding is consistent with the facts, which you might be able to assess by seeing whether in fact there is an SEC filing and Compustat failed to collect it.
We could do that. I mean, I don't know. We couldn't do it comprehensively, but I don't think. But we could certainly take a random sample. You think that would help?
I'm curious to know why things disappear from Compustat.
Yeah, yeah. Well, I mean, as this slide shows, what we do is we actually don't look at disappearance from Compustat. We look at disappearance from the crisp Compustat universe. And the reason we do that is we use crisp statements of reasons or crisp assessment of why they disappear. And so they break into performance and non-performance related reasons. And there are a few others that CRISP doesn't identify, which we call other. But that's all that we've done. And honestly, Steve, it's deliberate. I hear your question, but I mean, I certainly don't mean to dismiss it at all, but I think it's something that's different from our paper.
Okay.
We have two more questions.
Okay.
One actually. Sudhita?
I was just thinking about how this bias relates to other biases that we're also familiar with. So, for example, in the forecasting area, we talk about, say, IBIS. And we know that IBIS is biased towards large firms and profitable firms. So they're leaving out small, unprofitable firms, which seems to be very similar to the firms that Compustat is leaving out in your T+1 or whatever. Firms that are more likely to disappear from Compustat in some future period. So how do these two things relate to each other in your mind? Because we already have been sort of saying for a long time that all our results in IBIS-based forecasting are biased for that reason.
Yeah, I think so, Deborah. I think I hear the question, but I think the answer is not much. And the reason I say that is, I mean, really, I haven't thought about some selection bias in Compustat's decision to put in the data set or not put in the data set, or what effects something be in the data set, and we'll investigate, but I doubt that Compustat selection criterion is going to be substantial. The IBIS selection criterion, however, is gigantic, because they do follow firms that tend to be profitable. They don't start following a firm until it looks like it's going to be profitable. They're loath to drop firms that have already followed. So there's all kinds of bias. Not to mention there's sort of human nature biases, the natural tendency to be biased to curry favor, etc. So I think, though I'll think more about it since you asked the question, I don't think there's much connection at all. The other comment is, as we show towards the end of the paper, all of this attrition effect, or almost all of this attrition effect, occurs for small firms. It's not your question, but it's quite related to your question.
We know that from Carnahan's paper that small firms are more likely to report losses. So, I mean, those are connected, way back in the literature.
Yeah, they are, but, Carla's talking about reporting losses in year T-1, not T. So the attrition bias comes from dropping out of the data. Okay, so let's talk about the characteristics of these firms that disappear. So this is a plot of all disappearances on Compustat between 1980 and 2018. The fainter blue, for which the maximum number dropping out was 2.6%, represents those that are not identified, those that are not identified by type of delisting by CRISP. In other words, we know that they drop out of Compustat but CRISP does not give them a code. Then we've got this grayish area, which had a maximum number dropping out of 6.9%. The year before the burst of the internet bubble, 6.9%. And we have performance related to listings, which, no surprise, were maximum 5.7% in the year of the burst of the internet bubble. So, yeah. So then we look at other characteristics, scaled earnings, returns, and so on. So with respect to the mean scaled earnings, that is the size of the earnings in the year before they disappear. Of course, we don't have it in the year that they do disappear. The pink line represents all observations that are on Compustat. And the average earnings for these firms, the median earnings, I'm sorry, is 6% of price. You'll see that for the other delistings, the green, excuse me, let me make sure I get this right. For the non-performance related delistings, are roughly the same. For the other delistings, that is those for which we don't have a CRISP code, the earnings are lower. And the average, I'm just checking here, is not a whole lot lower, 0.05, the median, I beg your pardon. And for the performance-related delistings, you can see that these are very negative. The mean is, the median, I beg your pardon, EP, earnings deflated by price, is minus 0.49. Median returns in the year of disappearance. Let's focus on the performance related. You can see these median returns are very negative. The median across all these years is minus 56%. So for the firms that disappear for performance related reasons, these are very different. The performance is poor. I'm sorry, this is in the year of disappearance. Also, if we look at the percentage of lost firms, the percentage of the disappeared firms for performance-related reasons is very high. It's mostly losses, 75%. There's a fair amount of losses for the other delistings, and for the non-performance related delistings, and for the remaining observations, that is the green and the purple line, they're much the same.
Peter, we have a question.
Okay.
Jeremiah.
Hi, Peter. This is Jeremiah.
Jeremiah.
I think my question is related to the questions that you had earlier. So this sounds a lot like the research that looked at delisting returns, and that we need to include delisting returns because otherwise, we get some bias in the data.
Right.
I think one of the benefits that research had was they could go and look at the returns that investors actually would. So they have sort of a tangible thing to go look at and see what happened.
Right.
But here you're just kind of modeling what you think would happen. Is there a way to come up with some, either because your model is based on data that has attrition bias in it, and you don't actually know how companies perform when they leave the data, right?
Correct. I mean, you're right. And the accounting paper that does this says Beaver, McNichols, Price, right? Where what they do is look at whether accounting anomalies still exist in the data after we take into account. And notice these are estimates of delisted returns.
Right. Yep.
They're not delisted returns. And so, I take your point, but there are a lot of observations in all of those analyses. This is a large part of the finance literature that, they're all based on Shumway's findings for some of the delisting firms, but assumptions for the remaining firms.
Yeah.
So it's not as black and white as you may have indicated.
As I made it sound.
I think also, and we'll talk about the methods of imputation in a minute, and of course we would love to hear any other suggestions, but I think every one of those is conservatively biased. So one, if we find a change in the conclusions based on conservatively biased estimates of earnings for the firms that disappear, we can fairly comfortably assume that things would look worse if we actually knew the truth. And I'll come to that in a second. The other thing is, if, for example, we want to reject the hypothesis that earnings follow a random walk, right? And we just ignore all of those observations that disappear. Of course, we can't reject that hypothesis because it could be the 8.5% of the observations. In fact, loss of those observations drives the conclusion. In other words, drives a type 1 error. So to be sure that we haven't made a type 1 error, the only thing to do is to replace the disappeared observations with observations that follow the hypothesis. It's the only way to be sure. And that's one of our imputation procedures. But I'll get back to that.
Thank you. Yeah, thanks. I think that makes a lot of sense to say, if the goal is to see if properties that we've looked at change, right? If we might be making mistakes in how we look at returns and earnings or earnings themselves or something like that. That makes a lot of sense. I think what it doesn't do is tell us what is the imputation representative clear, you know, is there a strong correspondence between the imputation and what actually happens? I think you're saying it's conservative, and so probably we're not overstating the case, and I think that makes a lot of sense. But if we want to go further to say, is there, you know, maybe we're too conservative, right? If we want to actually understand that, what do the ones that are leaving Compustat actually look like, then we would need additional data to go get that, right?
No, that's absolutely the case. And we did walk a little bit down that path, Jeremiah, and I'll talk about that in a minute, for sure.
Yeah, thank you.
And probably, you know, what I learned from your question is some clarification of this point in the paper would be certainly worthwhile.
Yes, that would be great. Thanks.
Was there another question before I look more closely at the data? Okay, so now I have to work out how to use this thing so that I can see the data myself. Just bear with me a second. Okay. Okay, so these numbers just represent, or this table just represent what I've already talked about. However, what we've got is means and medians across all years, more or less. And here's the firms that remain on Compustat. Their median earnings in the year before disappearance was 6% of price. For the negative firms, it was 12% of price. Now compare that with firms that disappeared for performance-related reasons, essentially no difference in the positive earnings, but massively more negative earnings in the year prior to disappearance. In other words, importantly, the disappearance is not random. Similarly, if we look at annual returns in the year of disappearance, the annual returns, average annual returns, median annual returns for positive earnings are 9%, for negative earnings 11%, but in the year of disappearance, 25% for positive and 59% for negative. And I'm happy to look at the other partitions of the data, but most of the results are driven by performance-related reasons. So I'm going to focus just on these two panels unless there's questions about these two panels.
Peter, can I ask you a small question? I don't know whether it makes sense, but so like a companies with positive earnings at year T-1, how would they drop? Why would they drop for performance-related reasons?
It could well be that they're doing well and they get acquired, for example. Does that answer the question?
So will they be classified as performance-related then?
Yes, this is, yes. Yes, you can have positive and negative performance related to listings.
Okay.
But,
Okay.
but you can see, and I'm glad you asked the question because I wanted to point these numbers out. So most of the performance related to listings are for bad news. In other words, bad performance as indicated by the stock market, stock return, and very negative earnings in the prior period. So this breakdown, I think, answers your question, Vulcan. Okay, so then all of our analysis are based on annual earnings, but we do have quarterly earnings. So we have quarterly earnings in the earlier quarters of the year in which firms disappear. And so we analyze those quarterly earnings. So the median quarterly earnings for when earnings are positive is 2% of price, negative earnings minus 2% of price. But for firms that disappear for performance-related earnings, the median earnings in the quarter before they disappear is minus 3% of price. For negative earnings, it's minus 26% of price. So this is the earnings in the early quarters of the year in which the firm actually disappeared. We also look at the quarter over quarter change in earnings from 4 quarters ago to the quarter in which, in the last quarter that the firm exists in the year before they disappear. The median change is 0 in the entire sample of the remaining firms. For the firms that disappear, it's very negative. In other words, this is a quarter over quarter decline. And notice that these are quarterly earnings, not annual earnings. So multiplied by 4, roughly speaking. So then, any questions, a bit more questions about the data before we look at what we do with it? Okay, so then we do 2 things. First of all, we run a simulation, and this is really to describe, to demonstrate what would happen, as most to ourselves as to the reader, what would happen if we simulate data that 1 looks like Compustat and 2 follows a random walk. And then we remove observations in a way that mimics the disappearance from Compustat. So we generate random walk earnings in period T based on the earnings that are actually observed in period T minus 1. And then we run our regression. And you'll see that the coefficient, of course, is 0 on the intercept, 1 on the slope coefficient. But then what we do is we progressively remove 1%, 2%, 3%, 4%, et cetera, up to 10% of the poor performing firms. Notice from the previous charts that these are the firms that disappear. And we see that the coefficient on the loss dummy declines and the coefficients on the earnings interaction firm term decline. The next step is we look at real data, and this is focusing on Jeremiah's question, though not answering his question, talking about how we impute the earnings. So we follow 3 procedures. First of all, earnings follows a random walk. Now we would argue that this is conservative in as much as if the conclusion in the literature is that earnings follows a random walk, which it pretty much is, in Liam, Hammerin, Gracchus, and Gramercy, for example, them being the recent papers, then that conclusion is based on observations that remain. In other words, observation, in order to get that conclusion, earnings follows a random walk, earnings that disappear must be worse. Yet we're considering they're just the same as last year on average. So this one's conservative. The second one is if we've got earnings in the first quarter, we multiply it by 4 to first quarter of disappearance, we multiply it by 4, get a proxy of the earnings for the year. If we've got earnings for 2 quarters, we multiply by 2. If we've got earnings for 3 quarters, we multiply it by 4 over 3. And so basically we're saying whatever happens in the quarters that we know of will continue to happen. Again, that's going to be conservative because chances are pretty high, given what we see in table 2, that it will be even worse in the remaining quarters of the year. So again, it's conservative. And the last one, we use the fact that we've got delisting returns, and these are the same delisting returns that have been used in the finance literature and in Beaver, McNichols and Price. And what we do is we take that delisting returns and use the industry, Farmer Fringe industry EP ratio to carry the earnings of the subject firm forward a year. This one, we're not suggesting bias in one direction or the other. And then finally, as in all analyses in our literature, we've got 3 measures of imputed earnings. So we take the average of the 3. And most of the results that I'll be presenting are based on the average, but the results for all of these are presented in the tables.
Peter, we have a question.
Yes.
Sulita?
Peter, for the quarterly one, the second one, I'm not as happy with that one because we know that the fourth quarter tends to be much worse because of impairments being concentrated in the fourth quarter. So I was thinking maybe if you try to do a seasonal random walk instead, so you sort of take the difference between the current quarter and the previous, 4 quarters ago, and extrapolate that to the other quarters. I think that would give you a better benchmark than what you're doing right now. I mean, this is probably more inflated than the other one, but I think that would probably be more accurate in terms of imputation.
I hear you. We could easily do that. And as a matter of fact, this is something where any reasonable imputation method should be considered, and that's certainly a reasonable one. My hunch from the data is it's going to look very similar to what we've got here, although I take your point about impairments. Martin, feel free to jump in on that question if you disagree with me. I'm not putting you on the spot. If you agree, then we just move on. Okay. So then to get into the real meat of the paper, again, we run this regression, and this is a scaled regression. So we scale by price, and it's price at t-1, scaled all variables. So we run the regression based on the actual sample of Compustat data. The coefficient on positive earnings is 0.754. In other words, if earnings was $1 this period, it will be 75 cents next period. But the coefficient on the loss term is negative. In other words, positive earnings tend to persist 75%, so to speak, whereas negative earnings persist about 53%. In other words, negative earnings tend to mean revert more than positive earnings. But then we do the same analysis, but now with our imputed data. And you'll see, of course, here we've got an additional number of observations, 8.5% more effectively. The coefficient on positive earnings doesn't change, essentially doesn't change. But the coefficient on negative earnings changes from negative to positive. In other words, with these imputed earnings, we show that the earnings tend to be more persistent or less mean reverting. We've also modified the sample just looking at performance related to listings and non-performance related to listings. And the conclusions are pretty much consistent with what we see here, since the difference is driven by performance related to listings. We then also look at this these coefficients over time. And the data are the data. This is essentially showing that positive earnings are pretty persistent through the late 90s, and then there's a steady decline through 2018. In other words, conclusions that we may have come to based on earlier data do not hold based on later data. Now, what we've got on this chart is both the red line, which is with imputed earnings, and the blue line that is without imputed earnings, and with confidence intervals, 95% confidence intervals around each line. And you see these two results are much the same. In other words, consistent with the table that we've just looked at, imputation doesn't make much difference. But for negative, we have a different story. So with no imputation, we see evidence of mean reversion. But when we impute the earnings, much of this evidence goes away. And in many years, the coefficient relating negative earnings to earnings in the next period is not different from 1. The confidence interval spans 1.
Steve has a question.
Steve.
So just a question about whether this is the only strategy to deploy here to deal with the issue of firms disappearing from Compustat.
Okay.
So your strategy is to say they disappear, and in those instances of disappearance, what I want to do is impute what isn't in the data but should be, which is the earnings for the following year.
Exactly.
An alternative might be to say, well, if they disappear in year T, maybe I should remove year T as an observation. So trim the data rather than impute and invent new data, but maybe T-1 as well. And if you do that, do you also address the problem?
Well, I think not. I get your point. In other words, we perhaps could knock off T-1 and T and just start at T-2 perhaps. I think there's a couple of issues. First of all, T-1 for the disappeared firms is clearly quite different to T-1 for the firms that remain. And so again, we just be introducing a different kind of attrition bias. Also, and this is more the case, of course, if we knock off T-1 and T, we've got survival bias. I hope that answers the question. Okay, sorry.
Questions. So one was whether the attrition is because of CRISP dropping data or Compustat. You said it was a Compustat CRISP intersection.
Right.
But is it because CRISP, the firm was delisted from the New York Stock Exchange and therefore you don't have data? Or is it because Compustat itself is not covering the firm? Because
yeah, I don't know the answer to that question, but Sudipta, that's something we can easily check.
And then the second question was, you responded to Steve earlier that there was 191 firms that came back into the sample.
Yes.
So when they did come back, they must have reported earnings for previous years. Could you test that subsample of 191 firms against the imputations?
That's interesting. No. We could certainly tell you what happens for some of the firms in the intermediate year, but these firms will be a biased sample, right? The firms that go out for whatever reason then come back in, they're not going to be representative of firms that disappear.
But it gives you some idea of the error band around your estimates of the imputation, right? It's a different way of getting at, if this is a biased sample, at least this is some idea of the accuracy of the estimates. The other place you could look for is M&As. So if they're reported as separate segments in the acquiring firm, then again, you could get an estimate of earnings from there. So again,
we've thought about that for, sorry.
Yeah, good.
We've thought about that for a subset of firms, and we could sort of do a random check. I mean, the reason we hesitate, or I'll speak for myself here, but the reason I hesitate to do this is these data we're using are the data that are used in much of the literature. And so, you know, we may be able to provide some stories at the margin, but that's sort of all they are. The comment is much the same. You know, I sort of see your point about we are suggesting a method of imputation here. And maybe we can get some, what's the word I'm looking for? Measure of the validity of the imputation. At the same time, I feel, I mean, like your suggestion about the using the change as another method of imputation, but not this one, because it's likely that the firms that disappear for a period, for a year, are going to be better performers in the year after they come back. So it's a different kind of bias. But let me think more about that.
You can describe it at least and then tell us, then the reader can infer whether it's worth doing it or not. But
sure, I mean, it's easy to do.
Yeah. I think so. That's why I'm suggesting it.
Yeah, no, fair enough. Thank you. I'm running out of time. No, sorry, there's another question.
So Peter, this is a very naive question. I just wondered that right now you use this imputation method to fill 1 year after the missing year. Why don't we consider filling 2 years? How do we gauge that how many years we need to fill the data after the firm disappeared from quiz Compustat?
You know, I hear you. And we've thought about that. And the reason we've thought about that is that there's a big literature of which Stephen is a big part that looks at changes in ratios over time, back to the original Beaver-Morse paper and then Nissim and Penman. And both of those papers in particular go out 5 years. But we're getting pushback in this presentation about imputation 1 year out. We hesitated to go out any further just because the imputed earnings tend to be very different. In other words, the firm's disappeared, it's gone. It doesn't suggest, we can't suggest much about what the firm would be 2 years hence, 3 years hence, 4 years hence. And so we
I see. So it's a kind of a measurement limitation, because initially when I thought about this question is, think about this pharmaceutical drug clinical test example you gave earlier. I'm asking you that what's the expected life if this patient is not died in year T? How do we think about like how many more years this person may have lived to be included in the sample to be more representative of the truth?
No, I hear the question, but I think we talked about going down that path, particularly Martin and I talked a lot about that, but we decided not to go further down that path because the point can be made with the 1 year out. You know, honestly, I don't think it's unfair to say if people want to extend it further out, that's a different paper and someone would be welcome to do that. That seems like a cop-out, but I don't mean it to be. I think that is the answer.
Thank you.
So in the interest of time, I'm not going to look at these simulated results unless someone wants to. Okay, so then we look at forecast accuracy. So the forecast, of course, is going to come out of these this regression that we've put up several times, earnings on lagged earnings with a lost dummy. And we run that regression with and without imputed earnings. We look at the difference between the accuracy of forecast based on the regression and the accuracy of forecast based on a random walk. And in the paper, we do this for one regression, but you'll see in the footnotes, we report similar results for the other regressions that are common in the literature, Ho van Dijk and Zhang, for example. So then if we look at the difference in accuracy, the random walk is slightly inferior to the regression-based forecast for profit firms. and way inferior for loss firms. This is for the data that remain on Compustat. But now we impute our earnings, and this is for the average of all imputation procedures, but it's panels B, C, and D. We look at the individual imputation procedures, and you can see that the result for profit firms doesn't change, but the result for loss firms goes away. In other words, this is pointing to a type 1 error. And the type 1 error is suggesting that a random walk is inferior when, if we impute the earnings, for example, with a random walk, but in this case, the average of all procedures, that hypothesis is no longer rejected.
Peter, would you like to take one question?
Yes, please.
Sanjay?
Hi, Peter. I think with the imputation, is it possible to use these point-in-time tapes of Compustat to see whether, firms that were previously dropped now are refilled, so you can see how well your validity is of the imputation process?
Yes, possibly. I'm not too sure we're going to pick up much there, though.
Okay.
Yeah, because importantly, we use the fundamental file here, not the legacy file. But let me think more about that. My guess is we're not going to have many additional observations, but that's a guess. So we also look at positive and negative over time, just as we did with the coefficients. No surprise, the coefficients are different, whether we use imputation or not, and the accuracy doesn't differ, whether we use imputation or not. You can see the big effect of the global financial crisis here. That's for the positive. For the negative, on the other hand, if we just use the results as on Compustat, which are the results reported in much of the literature by, for example, Liam Mahamran, Garakis and Gramercy, the two quite recent papers that do this, you can see that you would come to the conclusion that we beat a random walk in pretty much every year, the blue line. But now if we impute the earnings, in pretty much each year, we get the same result as a random walk. In other words, no superiority to a random walk. In other words, this is a pervasive result for the negative earnings. So we get type 1 error. Earlier, there was a question about, this is Sadipta's question about IBIS bias. And I said that our results apply pretty much to the small firms, not the big firms. So we split the firms into those above the median market value and those below the median market value. And importantly, this is only 3% of the total capitalization of Compustat. In other words, though half of the firms actually have lower value, when you look at the fact that these are all very small firms or pretty small firms compared with these that are very big, most of the market cap of Compustat is in this sample. And we make the point, therefore, that people who are concerned about this attrition bias may have hypotheses that don't necessarily apply or shouldn't necessarily be tested with small firms. And therefore, a way of avoiding this problem is just to look at big firms. So again, we run the regression for both samples, no differences. For the actual sample and modified sample, these numbers are effectively the same. But below the median, we get all of the action. So just as we saw for the total sample, the persistence of negative earnings is lower, but for the imputed sample, the persistence of negative earnings is higher. The last thing that we did was the literature that we're focusing on deliberately in our paper is the levels of earnings. But the very early paper on earnings persistence, Farmer and French, focused on changes. Now, this, of course, asks a different question. So the question that we've looked at is, if earnings are positive levels, then can we expect them to persist to the next period in a way that differs from negative earnings levels? What Farmer French was saying is, if you've got a particular year in which you get a big positive change or a big negative earnings change, to what extent do you get a reversal in the next period? So the focus is very much on earnings changes in that paper, which when we presented it before, in particular when Martin presented it at Tilburg, the question was asked, well, what do you find in these literature in that regression? And so we added this on, basically to sort of link us back, if you like, to the finance literature, but with no intention of making a point about this regression in and of itself. So we, again, run a similar regression to before, where we've got a earnings levels interaction term and an earnings changes interaction term. Now, this regression gets quite complicated. And so what we've done is, instead of reporting the results with all the dummy variables, we've taken the coefficients that we would get essentially if we just ran 4 separate regressions. What is interesting is that, I mean, we can look at any one of the numbers here, but there's one result that really hits me, which is, here's the coefficient relating negative earnings changes last period. A negative change from a negative level of earnings, negative change. In other words, the earnings becomes more negative than it was. We find overreaction, over mean reversion. In other words, if we have a $1 negative change in period T-1, we've got a $1.14 positive change in T plus in T. Now, a lot of that is driven by attrition bias, because if we impute our earnings, then the level of mean reversion declines substantially to 61 cents, so to speak. Also, in terms of the forecast accuracy, we could, of course, though the literature hasn't done this as far as I'm aware, we could, of course, form a forecast of earnings at T and compare it with a random walk, just exactly as we've done in the previous analyses. We seriously outperform a random walk if we don't take into account attrition bias, but we're no different to a random walk if we take into account attrition bias.
Peter, we have only 5 minutes. Itai has a question. I don't know whether it's a short question. Itai, do you want to jump in?
Oh, yeah, sure. Thank you. Just a quick question that is related to the previous table. So I was wondering, for the persistence of losses, especially for companies below median market value, does that imply that these companies are going to be involved more in bankruptcies in the future? I mean, what might be the characteristic of these companies and what might happen in the following years? Is there anything that we can learn from the different persistence, especially for losses?
Sorry, I'm not sure I understand the question. Do you want to?
Yeah, I'm sorry. So for companies that report losses, we can see that there is a difference in the persistence, right? I mean,
yes.
When you take into account the companies that disappear.
Yes.
So the question is, what can we learn from the different persistence for these kind of companies? does that mean that it implies that for these companies, they're going to be involved in more bankruptcies in the future, for instance? What can we learn from this?
Yeah, yeah. I mean, it sort of comes back to, I mean, I recall saying, at least to my MBA students, you know, of course losses are less persistent than profits. Otherwise, the firm will go out of business. Well, what this shows is that they're not more persistent, right? And losses are similarly persistent or even more persistent, meaning because they go out of business. In other words, it kind of flips the logic. Does that answer your question?
Yes, definitely.
Okay. Okay, so in conclusion, just a second. So in conclusion, data disappearances certainly affect the inferences. This may not be a problem if the researcher is prepared to just look at big firms, and big firms do comprise a huge percentage of the market capitalization of Compustat. We suggest methods of imputation. We've got another suggestion today. And we feel that these methods may not necessarily be used, have to be used as a method of forecasting or imputing in all studies. On the other hand, sensitivity of the results to imputing earnings in the next period really should be examined, because the results are very sensitive. So I think I'm out of time, right, Volkan?
You're right on time. This is wonderful.
Okay. So the next speaker in this wonderful series that Young has put together